This is Shelley Craft coming to you live on SNNLive. We're at the New Orleans Investment Conference 2016. With me is Jeffrey Klenda from URG, URG on the NYSE markets, and URE on the TSX. Jeff, welcome to SNNLive.
Great to see you again, Shelley. Thanks for having me.
It's good to have you back. Let's talk about the company. Let's get an overview, and then we'll go from there.
Okay, great. URG is a company that I founded along with a couple of other partners about 12 and a half years ago. We are a uranium producer. We had one ambition when we started this company, and that was to be a low-cost producer that would provide product to the United States utilities. We are the largest consumption market in the world with about 100 nuclear reactors up and running, so we are the largest nuclear fleet. And we've not only succeeded in becoming a low-cost producer, we have become the lowest cost producer, not only in the United States, but also the lowest cost producer globally across all publicly traded companies. But it's not good enough to just have low cost production. You also have to be able to sell that product. And I think we had great foresight, our board did, and so we put in place a large number of offtake agreements going all the way out to the beginning of the next decade that represent about 60% of our uranium production, and at $50 a pound. So actually in what is now a sub $20 uranium spot market, we are realizing $30 margins. We're very proud of that.
I'm not going to ask you about the technicalities of how come you're the lowest cost producer, although I'm sure investors could certainly want to know. But how do you survive with sub 20 uranium costs when you're trying to expand your business, get new business to grow? You know what I mean?
Yeah, understand. And you look, let's be candid here. At under $20 a pound, most of my peers are not going to survive. This is what my market consultant has dubbed the blood zone, and I think that it's appropriate. Unfortunately, even the lowest cost producers in the world, when you're talking Kazakhstan, that's now responsible for 40% of all global primary production, their average production cost is $32 a pound. How long can they keep producing and selling into a sub $20 marketplace? Remains to be seen. That's why you have to have the long-term contracts. And again, I credit my board with a tremendous amount of foresight. I guess actually when Fukushima happened, which was about 5.5 years ago, the disaster that shut down the Japanese plants, I'm just old enough to remember 3 Mile Island, and so as a result of that, we couldn't wait to put the long-term contracts in place because we felt that we wanted to make sure that our shareholders were protected, and we think we've done a pretty good job of doing that.
So what's your stance on exploration and further development for more resource?
Well, I think right now the simple fact of the matter is that in any of the extractive resources, you reach a point, a threshold below which it simply doesn't make any sense to try and develop resources organically through the drill bit. It's much cheaper to go out there and buy existing projects. We actually crossed that threshold a long time ago. So we're always opportunistic. We're going to look for additional resources, but right now we are not exploring. We did an exploration drill program last year. It was very successful, but we don't anticipate doing one this year in 16 nor next year in 17. We need a rebound in prices to justify that.
Now, you gave me an overview of your company. I think I want to get a little bit of an overview of the industry, particularly supply and demand, and how, like for instance, if you're in the position you are with long-term contracts, and the market picks up, right, and the price starts to move, how much do you sell at these levels?
Well, right now our contracts cover about 60% of our production. So we're very happy to have that in place. But I think that given current global supply and demand, I'm going to be a little different than most people when it comes to supply and demand. I think that the growth rate in China and Asia and elsewhere in the world, mostly outside the United States, is very real at 2.5% to 3%. So that's a very respectable growth rate. The problem is that are the Chinese going to build out at a rapid enough rate to offset the number of plants that are closing globally? That remains to be seen. So that's a bit of an offsetting factor. I think that right now, as a result of that, we still have a lot of players that are producing uranium globally. There's still a glut of supply, and consequently, there's inventory out there that needs to be eaten through. And my feeling is that that's going to take a little bit more time. We just broke $20 on the downside, and the simple fact of the matter is that there are only a handful of companies that can afford to continue to produce and sell product into the marketplace at that price.
Where are you located resource-wise in the U.S.?
Our projects are in the state of Wyoming, and we're concentrated in the south central part of the state in the Great Divide Basin. It is great uranium country. It's great permeability and porosity, great flow rates. And so actually Wyoming, along with Texas and very few other areas, are prime production areas for uranium. And we're happy to be in the Great Divide Basin. In fact, we're the only player in the Great Divide Basin.
So what grade are your resources?
Well, actually, our resources are only about a 0.05, which you would think is a very low grade. But actually, the way the in situ process works is that we are solution miners. We basically pump a bicarbonate of soda through the formation, dissolve the uranium in place, and then pump it into the plant where we strip out the uranium. And actually, these grades are perfect for that. And we have found that our Lost Creek project, which is our first producer, has turned out to be incredibly prolific. We're still in our first mine unit, and we've been producing it for 3 years and expect to produce it for another 2 years. So we have found that we have optimal grade for our production needs.
What's your background, and who are some of the other part of the management team?
Well, my background is in finance, and I'll be honest with you, I was kind of dragged kicking and screaming into the uranium space, and I wonder what I did to deserve this at times. But the reality is that the uranium space, when it's moving, is just really, it's spectacular what can happen to the uranium space when the interests shift to it. We have great people on our board of directors, a lot of highly technical people, and what we have done is that we have tried to fill the positions that we feel that we need. And our board, to their credit, has been responsible for our offtake book and to put us in the enviable position that we're in right now. So I like to think that we've done a pretty good job of selecting those board members.
Let's get your website out there for more information, if you would.
Our website is www.ur-energy.com.
Ladies and gentlemen, Jeff Klenda, UR.Energy. It's a publicly traded company. I'm going to give you two symbols. URG on the NYSE markets, and TSX, it's URE. Jeff, thanks for coming on.
Shelley, thank you so much. Really appreciate it.
You got it.